Well, no tax cuts and no more quantitative easing. Neither will fix this broken economy. That's what Nobel laureate and Columbia economics professor Joseph Stiglitz says. He joins us now from D.C. to talk about it. Thanks for being here. Appreciate it.
Nice to be here.
First of all, let's talk about why what has been deemed QE2 or more printing of money by the Fed, why that won't work.
QE2, let me explain why that's not going to work. Monetary policy, short-term interest rates are down to zero. That's not worked. And so what is QE2? What that is lowering the long-term interest rates by intervening in the bond market, mortgage market. We tried that before, didn't work. The reason it's not likely to work is twofold. First, it's very difficult to get those long-term interest rates down, but even if you did, that's not going to translate into lower interest rates or more capital, more funds available to the small and medium-sized enterprises that are really hurting. The big companies are awash with money, so a small change in the long-term interest rate isn't going to affect their investment. It's the small firms that do need money. The problem is our banking system hasn't been fixed, and a little change in the interest rate isn't going to solve that problem.
You've called the Fed's policies strange. You've said, look, they're creating chaos, financial chaos in emerging markets. What it sounds like you're saying, Professor, is that emerging economies are reeling from what our Fed is doing, from our policies, and it's not helping us. And more aid from the Fed, more quantitative easing won't help us.
That's exactly right. I mean, basically what's happened is that the Fed wants to get our economy going. Their intentions are perfectly right. But the money, instead of going into fueling the American economy, is looking around the world for the best investment opportunities. Totally understandable in a world without any constraints. The best investment opportunities, the best way return on your money is in the emerging markets. They don't need our money. They don't want our money. So what's going on
They don't want our money? I don't know if they'd all argue that.
No. The real point is their economies in China, India, Brazil are doing fine. What they're worried about is this influx of short-term money, not long-term investment.
So you're saying a bubble.
But they don't want a bubble, and what it's doing even worse is it's increasing the value of their exchange rate, making it more difficult for them to export. And they're worried is that all this instability, money coming in, money going out, will destabilize their economy. So the result of this is they're putting in constraints on capital flows, taxes. They're trying to do all kinds of things to stop this inflow of money. What that is doing is fragmenting the global capital market. So rather than creating a more dynamic, efficient global economy, what we're doing unintentionally is actually having an adverse effect around the world.